Welcome to the Deep Dive. We're inviting you into a world where, honestly, every single detail in a report, every line item, it holds a key.
It really does.
Yeah.
A key to understanding some pretty complex systems.
Yeah, systems that often reveal, well, surprising truths about how things really work. Today, we're taking one of those deep dives into auditing and assurance.
But this isn't going to be some dry academic lecture.
Definitely not. Our source material is, well, it's quite unique, actually. It's basically a behind-the-scenes look.
Insights from a recent professional exam session looking at how auditors are actually evaluated.
Exactly. So think of it as getting a shortcut, really. A shortcut to understanding what truly matters in financial audits.
Why that precision is just everything.
And what separates, a really solid audit from one that maybe misses the mark. Our mission for you, our listener, is to grasp not just what auditors do,
but the why behind it. The real-world impact of getting it right or wrong.
And this kind of analysis, drawing from how proficiency is actually assessed, it's invaluable.
Yeah, it really highlights the strengths, but also the common weaknesses you see in practice.
It offers that constructive advice, clarifies the nuances.
Basically, we're trying to give you a clearer map for navigating these core principles of financial assurance.
Okay, let's start unpacking this. We're beginning with insights from the final stages of an audit, using a case study, Jovi & Co.
Hypothetical, but very realistic scenarios.
So picture this. It's the audit completion stage for Jovi & Co. Their draft profit before tax. It's $1,600,000. Pretty healthy.
But, as often happens, the audit uncovered some misstatements.
Right. And crucially, management refused to adjust them. We're talking about issues with purchases, an allowance for receivables wasn't made, depreciation errors.
Typical things that might come up.
And on top of that, their current ratio jumped significantly, and, well, a legal claim popped up late in the day. Something about defective materials. Now, a really key part of this final overall review is reassessing materiality. So, confirming that the threshold for what counts as a significant error, that it's still appropriate given the final numbers. Why is that reassessment so vital right at the end?
Well, what really stands out here is the timing. The precise timing and the role of each procedure.
Okay.
So while you do other things at completion, like checking for subsequent events, reevaluating ethics,
Sure.
those aren't technically part of the overall review of the financial statements itself. Reassessing materiality, that's about checking if your initial judgment of what's big enough to matter still holds true for the final picture.
It's that last critical check on the overall view.
Exactly. Making sure the benchmark still fits the final figures.
Okay, now this is where it gets really interesting. The insights from this examiner's report. They show some very strict rules, professional guidelines around handling uncorrected misstatements.
Oh yes, ISA 450 territory.
Right. So auditors must, no question, they must communicate these uncorrected items and their potential impact on the opinion.
To those charged with governance, the board, the audit committee, whoever's overseeing things.
And they must keep a detailed record, a schedule of every misstatement found, unless it's clearly trivial.
Absolutely tiny, yeah.
And finally, they must ask management for a written representation. Basically, management has to state whether they believe these uncorrected things are immaterial, both on their own and all together.
The aggregate view.
And here's a little surprise, something the report highlighted. In the example questions they used,
Yeah.
all the statements describing these required actions, they were true.
So not a trick question mix.
No, which really underscores that auditors need to be confident in what they know. They can't just second-guess the rules.
And that raises a really important point, doesn't it?
Yeah.
Why is it so critical to just know the standards rather than trying to guess?
What do you think?
Well, it goes right to the heart of audit integrity. The whole process relies on these objective standards. You can't just sort of, assume there might be a gotcha. You have to know the regulations. That's what ensures reliable financial reporting.
Okay, let's dive into a critical point about those individual misstatements. To give an unmodified opinion, what people often call a clean opinion, misstatements that are individually material, like for Jovi & Co., that $124,000 allowance error or the $114,000 depreciation mistake, they can't just be offset by other errors.
No, you can't net them out if they're individually significant.
Right. So connecting that to the bigger picture.
It just emphasizes the auditor's core responsibility. They have to make sure management addresses those significant individual errors. They can't let them get buried, just because other things might balance out on paper.
It's about preventing a misleading picture.
Precisely. You can't mislead the users of those statements.
Now, let's look at that increase in Jovienco's current ratio. Auditors use analytical procedures, ratio analysis to understand changes like this.
Standard procedure.
So what makes for a valid explanation versus one that just doesn't add up? For example, if someone suggested increasing the allowance for inventory.
Right, that would reduce inventory, reduce current assets.
So it would decrease the current ratio. Clearly not the reason for an increase.
Doesn't fit the facts.
But what about converting an overdraft into a long-term loan?
Now that could explain it.
Why?
Because you're moving a liability from current to non-current. So current liabilities go down, current assets stay the same.
Which mathematically increases the ratio. Makes sense.
It's understanding those links between the accounts.
Okay, shifting gears slightly. What happens with that legal claim? The $100,000 defective materials, one, discovered late. The scenario says it's possible but not probable they'll have to pay.
Right, and it's not fundamental to understanding the company.
And crucially, management did disclose it correctly in the notes to the financial statements.
So in that specific situation,
even though the issue itself is material, because it was correctly disclosed, and it doesn't fundamentally distort the overall picture.
the auditor's opinion stays unmodified.
Exactly. No extra paragraph needed in the auditor's report itself because the company's own disclosure handled it properly. Okay, let's move on. Let's transition to a more in-depth case. Pimento Co., a large retailer. This one covers broader responsibilities, starting with fraud.
Always a critical area, ISA 240.
Auditors have that specific responsibility, right? They obtain reasonable assurance the financials are free from material misstatement.
Whether caused by fraud or error. That specific phrasing is absolutely key.
Why is that bit so important?
Well, just saying free from material misstatement isn't quite enough. Adding the whether caused by fraud or error part, that clarifies the auditor's specific duty under the standard.
Okay.
It also makes clear what they're not responsible for. They aren't fraud investigators in the forensic sense. Their main job isn't detailed investigation or, public interest reporting beyond the financial statements themselves.
Got it. Reasonable assurance against material misstatement, fraud, or error. Now, identifying and responding to audit risks, that's a huge part of the job.
Absolutely fundamental.
And often in these scenarios, there are actually more potential risks mentioned than you strictly need to address, so you have to pick the most significant ones.
Prioritization is key.
And when you identify one, just stating a fact isn't enough, is it? You have to explicitly label it as an audit risk.
Correct. And then explain it properly.
Explain it how.
You need to state the specific financial statement area affected, like revenue or inventory or PPE. Then the assertion.
Assertions being management's claims, like valuation, completeness.
Exactly. Is the risk that assets are overvalued or that liabilities aren't complete. And be specific about the potential outcome. Overstatement, understatement, misstatement.
So not just PPE is wrong, but risk of overstatement of PPE valuation due to.
Precisely. Or risk of understatement of depreciation expense. Be very clear.
And the examiner's report highlighted some common misunderstandings here too.
Yes, things that candidates often get wrong.
Like how often a company's internal audit team visits somewhere, that's not really an external auditor's risk factor.
Not directly, no. Or confusing upgrading a depot, which is usually capital expenditure.
With a revaluation, different accounting treatment entirely.
Right. And inventory valuation, it needs to be a close approximation to cost under IAS 2, not just applying lower of cost and NRV mechanistically.
And a bonus issue of shares. That doesn't automatically signal a going concern problem just because no cash dividend was paid.
No, those are different issues. These nuances really separate a basic understanding from real expertise.
Okay, so you've identified and explained the risk. What about the auditor's response?
The response has to be practical. It needs to be something the auditor does, not management.
And the goal is always getting good audit evidence.
Suitable, reliable evidence. And just saying increase professional skepticism, that's usually not enough on its own.
Needs more concrete action.
Yes, link it to specific actions, like performing additional substantive tests or more rigorous analytical procedures.
And discuss with management, also too vague.
Far too vague. What specifically are you going to discuss? And remember, the hierarchy of evidence, getting a confirmation from a third party, like a bank. That's generally much more reliable than just relying on what management tells you verbally.
Makes sense. Reliability is key. So for you listening, what does this all mean? It means understanding that auditing is really an art. pinpointing the genuine financial statement risks.
And knowing exactly how to design procedures to get the evidence you need to address those risks.
Okay, let's take a specific example. How do auditors verify something a bit unusual, like a trade discount receivable?
Good question. The report suggests thinking from first principles.
Meaning?
Well, first, what is it? Asset or liability? It's a receivable, so it's an asset. Cash expected in.
Okay.
Which accounting standard applies? What are the risks? Since it's a receivable, you'd expect payment after the year end.
So specific procedures might include
Things like recalculating the discount amount yourself, agreeing it back to the trial balance, doing some analytical review. Does the amount seem reasonable compared to purchases?
checking the actual cash receipt after year end.
Definitely. Agreeing that post-year-end payment to bank statements or the customer ledger, and checking the original terms, agree them back to the supplier contract or correspondence.
Get the documentation.
Exactly. You know, it's surprisingly common for people to confuse this trade discount receivable with just general trade receivables.
The wording matters.
Hugely. The devil is absolutely in the details. If you ignore that word discount, you might design totally irrelevant procedures. Just reinforces the need for absolute precision.
Let's talk about ethics now. Auditors face dilemmas all the time. The Pimento Co. case had some.
Ethical threats are a constant reality.
When you spot one, you need to identify both the issue itself from the scenario.
And the specific type of ethical threat it creates. Self-interest, familiarity, intimidation, confidentiality.
Right. Like if the finance director's daughter is on the audit team.
Straight away, that rings alarm bells for self-interest, familiarity, maybe even intimidation if the FD puts pressure on.
And you can't just say independence is impacted. You have to explain how.
Exactly. Why does it matter? So for instance, a contingent fee where the fee depends on the profit figure or the audit outcome.
Yeah.
Well, the threat is the audit team might be tempted to ignore adjustments that reduce profit because that would also reduce their fee. That's the how.
And the safeguards need to be real actions.
Concrete steps, not just vague objectives, and practical ones. Resigning is usually the very last resort.
So for that contingent fee example.
The firm absolutely have to refuse that fee basis.
Yeah.
State clearly the fee will be based on the time and expertise involved, regardless of the outcome. That's a concrete safeguard.
Okay, moving on again. Harper Co. and Everest Co. These scenarios bring in outsourcing internal audit, general internal controls, and that really critical concept, going concern.
Right. So first, Harper Co. outsourcing its internal audit function. What are the pros and cons?
But crucially, from Harper Co.'s perspective, right? Not the audit firms.
Yes, focus on the impact on the company outsourcing.
So advantages for Harper Co. could be getting access to specialist skills they don't have internally.
Maybe risk management or IT audit specialists.
And potentially cost savings, depending on the arrangement.
True. But disadvantages.
Well, potential redundancies for their existing internal audit staff. That can hit morale and productivity hard.
And you might lose valuable in-house knowledge and skills over time.
That specific company knowledge.
Exactly. Now, interestingly, some assumed disadvantages often aren't quite right.
Like what?
Like a general fear of losing confidential information. Professional agreements cover confidentiality very strictly.
Okay.
Or the idea that the outsourced provider won't understand the industry. Reputable firms absolutely do have industry knowledge. They might initially lack company-specific internal control knowledge, but they learn that quickly.
Okay, now internal controls themselves within Harper Co. Identifying weaknesses and recommending improvements, huge area.
Absolutely crucial for preventing errors and fraud.
And again, not every fact in the scenario is automatically a deficiency, is it?
No, you have to filter. Sales teams visiting customers, a retailer taking cash payments, that might just be normal business.
But a real weakness highlighted was goods received notes, GRNs, being checked only against the supplier's delivery note.
And not against the company's original purchase order.
What's the implication there?
Well, the company could end up accepting and maybe even paying for goods they never actually ordered. Opens the door to waste, maybe even fraud.
So when explaining the implication, you need to be specific about how it leads to potential error or fraud.
Yes. No credit checks, risk of bad debts, irrecoverable receivables, reconciling sales reports weekly instead of daily. Why is that a problem? Maybe errors aren't caught quickly enough.
And the recommendations need to be practical, action-oriented.
Detailed actions for management to take, saying, give purchasing access to GRNs isn't enough.
What more is needed?
They need to match the GRNs to the purchase orders. Or Follow up promptly on orders where no GRN has been received. It's about closing the loop.
Makes sense. Actionable advice for the company. Right. Let's look at Everest Co., an earthquake scenario. That presents some unique challenges.
Definitely pushes the boundaries of standard auditing.
So substantive procedures for property, plant, and equipment, PPE, after an earthquake. The key is tailoring, right?
Absolutely. Focus only on the things mentioned in this scenario: the repair costs, any new plant bought to replace damaged items, the disposal of scrapped assets, not just generic PPE tests.
So examples would be
Physically inspecting the new additions. Do they actually exist? Are they being used?
Yeah.
Recalculating depreciation, making sure it's for the correct periods on both old and new assets.
what about the repair costs?
Reviewing the invoices carefully, and critically, ensuring the accounting treatment is right. Was it correctly expensed, or should it have been capitalized?
Big difference.
Huge difference. It's amazing how often auditors fall back on generic responses here.
Like what?
Like saying, review board minutes for authorization. That's really a test of control over authorization, not a substantive procedure to check the asset's value or existence itself.
Subtle but important distinction.
Or suggesting obtain written representation. That's usually reserved for areas with high management judgment and little other evidence, not for verifying basic asset transactions where invoices and physical inspection are possible.
Okay, Everest Co. also had a big insurance claim receivable, $1.8 million. How do you audit that specific non-trade receivable?
Again, tailored procedures.
Yeah.
Focus only on that claim.
So you'd want to see the correspondence with the insurance company.
Definitely. Review all letters, emails. Check post-year-end bank statements. Did the cash actually come in?
Look at board minutes for management's discussions about it.
Yes. See what their assessment was. I'd probably get a specific written representation from management about the claim's recoverability.
What are common mistakes here?
Trying to apply standard trade receivable procedures, like sending confirmations. That doesn't fit an insurance claim. And auditors generally wouldn't contact the company's lawyer unless it's become a legal dispute, nor would they usually contact the insurance company directly without client permission.
Now, the big one. Assessing going concern. Can the company continue operating? Everest relies heavily on an overdraft that needs renewing annually and has covenants.
That definitely raises the stakes for the going concern assessment.
So what procedures would an auditor perform here?
You'd need to review correspondence with the bank very carefully. How likely is that renewal? Check the latest financials. Have any of those loan covenants been breached?
Discuss alternatives with management.
Absolutely. What's plan B if the overdraft isn't renewed? And you do the standard things too. Review their cash flow forecasts critically. Look at board minutes discussing the financial position and future plans.
Dig deep into the viability.
Exactly.
Yeah.
And it highlights, auditors aren't just bean counters. They have to assess the underlying business realities, the risks that could threaten its future.
And just listing indicators of going concern problems isn't enough, right?
No, that's a common mistake. Listing indicators like losses is observation. Listing the procedures, reviewing forecasts, bank letters, covenant calculations, that's the active audit work required.
Okay, so this is where it all comes together. How does this going concern uncertainty, the overdraft renewal happening after the audit report is signed, how does that impact the final auditor's report?
It hinges entirely on disclosure. This situation is clearly a material uncertainty related to going concern.
Right. So if management has adequately disclosed this uncertainty in their financial statements,
Then the auditor issues an unmodified opinion. The main opinion isn't changed. But they must include a separate paragraph in their report specifically titled Material Uncertainty Related to Going Concern. And this paragraph points the reader directly to the company's own disclosure note.
So clean opinion, but with a very clear flag about the uncertainty.
Precisely. The opinion itself is unmodified because the financials, including the disclosure, are presented fairly.
But what if the disclosure is not adequate? If management hasn't explained the situation properly?
Then it's a different story. Inadequate disclosure of a material uncertainty is itself a material misstatement.
So that leads to a modified opinion.
Yes. Most likely a qualified opinion, assuming the issue is material, but doesn't completely undermine the entire set of financial statements, making it pervasive.
And the report explains why.
Correct. The basis for opinion paragraph, which comes right before the opinion itself, would clearly explain why the opinion is qualified, detailing the inadequate disclosure.
The precision of the language here seems vital.
Absolutely critical. It's an unmodified opinion, not unqualified. Small difference in wording, big difference in technical meaning.
And you mentioned an emphasis of matter paragraph isn't used for this.
Correct. That paragraph is for drawing attention to matters already properly disclosed that are fundamental to users' understanding, but not for material uncertainties related to going concern. That has its own dedicated paragraph. This level of detail ensures clear communication.
No room for ambiguity when it comes to something this important.
None at all. Users need to understand the auditor's conclusion clearly.
So as we wrap up this deep dive, it's just so clear, isn't it? Auditing requires this incredible depth, this precision, this judgment.
From looking at tiny misstatements all the way up to judging the entire company's financial viability.
And upholding those ethical standards throughout. We've touched on, well, the critical nature of materiality, the nuances around fraud, responsibilities.
That strategic approach to risk, getting specific with procedures.
And the role of ethical judgment, strong internal controls, it all ties together. And these insights, they aren't just for auditors, are they? They give you, the listener, a direct window into how financial health gets assessed, gets assured.
Which impacts everything from investment decisions people make to just general confidence in business.
So maybe a final thought for you to consider. In a world that's increasingly driven by algorithms and big data, how does that meticulous human judgment, that ethical vigilance of an auditor, ensure not just, accurate numbers, but also trust, real trust in our economic systems?
It's a fascinating question. Where does that human element fit?
We really encourage you to keep doing your own deep dives on any topic. Keep digging, because the clarity, it's often just below the surface, waiting for you to uncover it.